This is Invested in Climate with Jason Rissman. I see climate as the world's biggest, most diverse, most important movement in human history. Millions of people dedicate themselves every day to protecting the planet. This podcast shares conversations with advocates, entrepreneurs, investors, policy experts, and anyone else that can push our thinking about what's possible and what needs to happen to address climate change. If you have ideas for episodes or feedback, get in touch on LinkedIn. If you enjoy the show, please leave a rating on Apple or Spotify. I'm currently building a new venture. It's related to storytelling and how we engage all sorts of folks in meaningful climate action. If you have expertise in this area, big ideas, or examples of something that's really working, get in touch. Thanks for listening and for doing whatever it is you're doing to support climate progress. Okay, let's get started.
I kind of feel like we might be finally at the cusp of that mythical, it's no longer its own sector. It's no longer clean tech, climate tech, sustainability, whatever we want to call it. It's actually just part of the landscape of all of these other traditional sectors.
Hi, everyone. We're back with another episode in our series on the missing middle in climate finance in partnership with Spring Lane Capital. This is actually our 6th episode in the series. To find the others or to reach out with ideas of series you'd like to partner on, go to investedinclimate.com. We're just at the start of 2026, and so it's a great time to talk to two prominent industry veterans who bring historical context and clear-eyed views of the year ahead. Yes, there will be some predictions, but in this episode, we go deep into nuances of investing in climate. I enjoyed taking a back seat for part of this episode, letting Spring Lane Capital co-founder Rob Day trade ideas with Raj Atluru, managing partner of Activate Capital. Both Rob and Raj have been in this space for decades, and I loved hearing about how the market has changed, the metrics they look for in portfolio companies, and the opportunities emerging from macro trends like interest rates, deglobalization, and AI's unprecedented energy demand. So listen closely and enjoy. Here we go. Rob and Raj, welcome to Invested in Climate. Great to see you both.
Great to see you, Jason. Thanks, Rob. Thanks for having me.
Great. Well, Rob, great to see you again. And Raj, this is actually our first time meeting, so great to meet you. One of my favorite things about this series on the missing middle is that it's kind of like showing up at Spring Lane Capital's house party and getting to meet all of their brilliant friends doing great work to address the missing middle problem. Or as Chris Anderson of TED mentioned in our previous episode, the missing middle tragedy. So Raj, no pressure, but I am really looking forward to this conversation. Rob, for listeners who haven't gotten to hear our previous episodes on the missing middle, give us a quick overview of the problem. What is the missing middle and why is it such a big deal?
Yeah, sure. Happy to. And again, thanks, Raj, for being here. Thanks, Jason, for organizing. And I'm actually surprised this is y'all's first time meeting together because, Jason, you've been around and Raj is definitely one of the OGs of our sector. And I think when I was just breaking in, Raj was already like one of the best known investors in our sector. And I've always learned a lot from him. So appreciate you being here.
Beautiful point of you, Rob. Thank you. That's kind.
Yeah, no, it's true. So missing middle, I mean, put briefly, and I know we've covered this in other episodes, but basically so many of the innovations here in the energy, food, water, waste, transportation landscape, even if they're not a hardware innovation, they're tied to the deployment of hardware, tied to the deployment of assets and projects. And in many cases where mainstream infrastructure is willing to step in is much later than the entrepreneurs and their investors, their corporate investors, their venture investors, growth investors would have liked. For us, what we see as a missing middle is how do you not only help the companies get to a point where they have deployed enough of those assets, enough of those projects, where they have the proof points necessary for mainstream infrastructure, and their billions upon billions of dollars of capital, which really then scale up these solutions. Not only how do you help them get there in terms of their own experience, but also what can you do to help them be institutional grade along the way as well? So institutional project development, project delivery, asset management, all of the things that are so execution oriented when you start actually trying to Lego things together. So that would be how I would describe it. Raj, welcome your take too.
Rob's doing, the traditional missing middle, which is taking these first of kind projects and technologies and getting to scale. So institutional, bigger infrastructure funds can start deploying capital more effectively. There's a lot of capital out there for deploying infrastructure, whether it's, more traditional stuff like wind and solar, and now storage, or new technologies. For us, missing middle is a little different, which is there's a lot of early stage capital both here in Europe and in Asia as well, focusing on climate, on infrastructure, on global systems resiliency, the three areas that we cover really well. And there's a lot of big private equity funds that raise a lot of capital in the space. And so most of those funds really don't want to invest in companies that are subscale. And so as we think about the missing middle, companies take their seed rounds, which have gotten bigger in my career, doing this for 30 years. And then you go Series A, and Series A is all about getting into commercialization, getting some level of commercialization. Then Series B and C is about scaling the company. And there's just not enough capital in that stage. There's a lot of early stage companies that are all doing really good work. And for us is how do we get a company that's notionally 10, 20, or 30 million revenue upwards of 75 or 100? And that opens up the playing field for other forms of capital, whether it's strategic capital or strategic acquirers, or whether it's larger private equity funds and infrastructure funds. And it's a lot of heavy lifting between Rob does a ton of heavy lifting on his side and a lot of the projects and companies he invests in both. For us, it's modernizing, upgrading reporting packages, upgrading the financial function, really getting companies ready to scale. Because the first Series A, Series C, and Series A, it's about finding product development. It's about finding product market fit. It's usually entrepreneur driven. And at a certain point in time, you're going to scale to a company that can get to 100 million as the first step, and eventually to 250, 500 million if they can be a public company. The TAM's big enough. It just takes a lot of team building and a lot of reporting on both financial metrics as well for us, impact metrics. What are the things that matter and that count? And so that's where roll up our sleeves. And so we're a firm that we don't do a lot of investments. We've made 32 investments since 2018. We founded the firm, and it's 1.25 about, and it's typically a broader team than just one partner. And I was an early stage venture investor for well over a decade at DFJ. And, I was on 16 boards, which had a lot of responsibilities, but it was typically a partner per company. And for us, just given the stuff we try to accomplish for our businesses, we just bring a team to bear. And so that's how we prosecute our business.
Raj, tell us a bit more. You dove right in and talked a bit about how Activate works on the missing middle in your own way. But let's rewind and just hear a bit more about the firm. Interesting that only one deal a quarter. Sounds like it's been around for almost a decade. Give us a bit more of what makes Activate stand out.
Yeah, absolutely. So we founded the firm, and really we thought about the firm in Q4 16. My two other founding partners have all been, they're the OG. One of my partners is the OG of the OG, so he's even more data than I am. But he founded one of the very first energy tech funds called Enertech in 1996, and that's when we first started working together. And so we had all, David and I co-founded the firm together when I was DFJ. Anoop and David have invested in 2 water companies. We just looked backwards in our careers and decided what worked and what didn't work. What was change in the industry? Because that first wave of clean tech and energy tech in the mid-90s produced some really pioneering companies, Solar City, Enernoc, Tesla Motors. As a whole, was generally considered a failure. And I don't think of it as a failure at all. I think it set the platforms of technologies for the future, right? Crystalline silicon, one of our thin film, lithium ion, one of our other forms of battery chemistries. And so it was a foundational period of time in technology development. As we founded the firm, we just looked backwards and said, these technologies were maturing. They were coming down the cost curve. A lot of the capital in that first wave, whether it was DFJ or KP or COSA or NEA, a lot of the capital had fled the sector because the returns weren't there. But the companies were maturing. We felt like there was a need for growth capital as these companies had matured their technologies, had found product market fit, and the capital availability wasn't there. So we set out to create a growth firm. So we're now in our third fund. We are incredibly research driven. So we're trying to find what are the avenues in sectors we want to play in. And so that means we are very selective in what we do. And we look for one company quarter. We're growth capital. So we invest somewhere between 15 and 30 million per company. And we tend to be lead in most of the things we do. And because we want to be heavy lifters. And so as we founded the firm, we thought about what were the prototypes or archetypes of firms we wanted to be. And we just said we want to be super specialized because these markets are hard. And we'll talk about that in the future. And we wanted to be specialists because, we want our voice to matter. We want to really be able to help create the companies that could be the dominant platforms for the future. And, instead of the venture model, which is, 50% of your portfolio fails, our goal was to be much more selective and, hopefully have a loss ratio in line with private equity, which is about 15%. And so we set out to go raise capital, and it was super hard. I talked to 300 LPs in Fund 1. We got 10, right? It was people were looking backwards on the first wave of clean tech. We're saying, hey, I just can't bring it to my IC. Fast forward 2021, sustainability came into bear. And so we leaned into climate. And so that, we raised our $500 million fund. Our target was 300. We hit our hard cap. Fast forward to where now the world's fundamentally changed. And so we're going to talk about that, I'm sure. But, our focus had moved from, climate mitigation was predominantly what we did in Fund 2. And midway through Fund 2, we said, look, no one's doing adaptation. No one's doing global resiliency. We talked to our LPs in 2022. did a big research piece on it. We leaned in because, climate is impacting all of our physical systems, our risk systems. And so we made an investment in next generation weather company. We made an investment in a low Earth orbit space company that was doing Earth observation, and really sort of pushed the firm forward. And as we think about where we are now, our core focus is on energy and infrastructure. And so it's even broadened because all of those are being impacted by a change in climate, whether you believe it's man-made or otherwise. The climate is changing, the risk systems are changing, and our physical infrastructure is not ready for the growth and load that we're seeing. And so as we thought about Fund 3, we continue to expand on peel the onion. And so for us, it's energy's core to everything we do in the world economy. It supports, GDP growth. It supports healthcare, communications, education in the globe. And, all of our systems are relying on the availability of low-cost power and the security around that. So if you think about the United States versus Europe, Europe is more concerned about energy security, given what's going on geopolitically. The U.S. is more concerned about energy availability because low growth in the United States is off the charts. And for folks like Rob and I, or Spring Lake and Activate, and other folks in our sector, low growth is the first time I've seen in my 25 years, 30 years of doing this. And so that's created unbelievable amounts of opportunity. And so those are areas we focus on. We're in our third fund right now. I've been doing this 30. I've never been more excited. Like, it's just what we're seeing in terms of innovation that's happening in real time, not just year to year, but quarter to quarter, is astounding. And a lot of that's driven by ongoing technology innovation. That's really amazing if you think about this year.
Rob, I'm sure you're chomping at the bit, as am I. There was so much that was just brought up.
I'm speaking too much.
No, I'm not chomping at the bit. Keep going.
Well, a lot of great things. And I think, Raj, as you've mentioned, we should definitely talk about how today is different than years past. And I think that historical perspective that both of you bring will be really interesting to cover. Before we do that, let's just understand the valley of death and how you see it, Raj, as a growth investor. What does it look like? Is it just different for each company, or are there some themes, both in terms of what are the challenges those companies face, as well as what does it take to get through it?
Yeah, so I'll start with the basic premise we always ask, which is why now? Like, a lot of these core technologies I've looked at hydrogen starting in 2004, right? So the question is, why now? What's different in the world? And some of it could be policy driven, some of it could be technology driven, some of it's just timing. So, as we think about our work, we're just looking at, the fundamental drivers of growth is people wanting to adopt technology because there's a driving need. The hardest thing about renewables and decarbonized generation was you're replacing an electron. And that's someone else's electron. So it wasn't low growth, right? So you're replacing coal, which we did really effectively over the last 20 years. You're not replacing natural gas, replacing oil in some places, and then we're electrifying. So that's going into the electricity grid. So it was always a push-pull because you're decreasing one industry while you're trying to grow another industry. Right now, for us, we are short electrons. And that's created opportunities for all of the above technologies. And that includes natural gas because that's the resource we have in the United States. But, there's problems with that in our economy as well because the availability of gas turbines, the volatility of pricing. We've had a lot of free gas in the United States for a long period of time. That's kept gas prices low. We're importing a lot through the form of LNG. And so as we think about it, we think about a couple of things. One is we're in a load shock environment, which is we are just short electrons. Everyone's racing for capacity. And that's the United States. Globally, particularly in Europe, where we spend a lot of time and where we invest, it's energy security. And they're going through a period where a lot has changed. Their best friend, the United States, for the last 7 years, has said, hey, it's time that you guys start remilitarizing, take control of your own borders. And it's time that you guys start reindustrializing. So that's created a really interesting opportunity because that requires energy if you're going to reindustrialize. The other thing that's happening in the United States, we're trying to reindustrialize our economy. That's a massive amount of low growth. Like, the industrial sector consumes more power than residential, right? And so that availability and ability to site stuff in places where you can find labor and people, which is another challenge. We're labor constrained in the United States. It means you need to do so through automation. We need more modern technologies as we think about scaling our rescaling our industrial sector. The other thing that's changed, and these are the macros, the other thing that's changed is we're going through a deglobalization, away from China. And that's created like a huge amount of opportunity within next generation supply chains. How do you think about procuring materials, including, things that are hard to get or mostly in China? So we're reinventing some stuff that we used to do 100 years ago, materials and metals processing. And so those are all the things that we think about. So those are why now check boxes. We are moving to electronic economy. So it's not just AI data center growth, which we're going to talk about, but it's reindustrialization and it's electrification. So those are the three big things in the United States for electricity and power sectors. And so as we thought about, what is important to us, we still want to shift to carbon-free, zero marginal cost electrons. that makes sense because we doing this for the next 20 years and these systems last forever, right? You're not taking fuel risk, 15 years from now, or labor risk because you're running these plants takes people too, right? And those are going to increase over time. And so we start with the macro. We look at policy. We try not to rely on policy because policies can change as it did, right? Over the course of this last administration. So it's important, especially for new technologies in this current environment. Nuclear needs support for sure because we got next generation nuclear needs to be supported. I think for sure geothermal, which is really it's one of the very few clean baseload technologies that we can deploy here because wind and solar are intermittent. I think wind and solar need to figure it out without incentives. Just continue to decrease it's incredibly inexpensive to deploy solar. It's the lowest form of electricity generation globally. That's why it's been deployed all over India. Look at India as an example. And so those are the macros of the why now we look at. Then we go down to the individual companies, and it's all about, can we underwrite to 50% growth year over year for 5 years? Can the company become a meaningful, important company, not just a moneymaker? Because it's, everyone thinks it's easy to build these companies. It's really hard. Like, there's no such thing as an easy 3X. Like, we're growth investors. When I was an venture investors, can it be a 10 or 100X or 10 or 50X? Different ballgame. Like, you're investing earlier, a lot more risk. At our stage, where you're trying to deploy capital more with a more risk, with a different balance in terms of risk, you can't lose capital. And so you get into this position where you think it's easy. It's not. Like, it's just not easy. Like, things happen. And so, we are really, really careful in terms of how we underwrite our businesses. And, we do our own modeling. We'll do 40 or 50 calls, off reference, just to understand sectors and, what are we betting on? And then it's the heavy lifting of like, hey, we're going to lock arms with CEOs. And Rob knows this really, it's really hard. What they do is incredibly hard. We'll help them augment build their business, build their management teams. And then we're there, as things go bump in the night and if something happens, we're the capital provider. We just sort of think long-term. And that's why having a limited portfolio right now, we invested 32 companies. We have an active portfolio of 24. And so, we're starting to see exits happen. M&A has been great. The IPO markets are coming back. And so I think you're going to see in this sector, like, a lot more enthusiasm because it sort of waned post 2021 into this administration. We'll talk about that. But that's what we see for the sector. So it is probably the best time in my career to be investing in this sector.
Rob, this episode was your idea. There are a lot of climate investors who say they're focused on helping companies reach scale, but the middle wouldn't be missing if everyone was doing what needs to happen. So from your vantage point, what's unique about Activate's approach, and why did you want to include Raj? Obviously, a really fantastic perspective, but also curious about their approach and how it stands out.
Well, I think you've heard a little bit right now listening to Raj as to why I thought this would be a great conversation. And, so it's really just a selfish move on my part to want to hold this conversation here. And when we look at Activate, we see, first of all, just the depth of experience. I mean, Raj talked about that up front, right? So I think one of the things that we keep seeing again and again in this sector is that it's not just the specialization, although that comes along with it, but also, like, how many battle scars do you have, right? How many of these scenarios have you seen? Everything Raj was talking about in terms of, how you support CEOs and how you support companies and prepare them to sort of graduate to that, next layer of capital is spot on, right? But that all comes along with having seen it before. And I think it's a great advantage for teams like Activate that are so experienced. Every single one of them have seen a lot of these cycles before. It's just a great advantage to be able to partner with them, for instance, as co-investors on a company and know the value add that they're going to be around the table. I also think this is a nuanced point, but everything Raj was just saying about the transition from, hey, let's do climate tech, to, hey, it's time to really get serious about adaptation and resiliency and those kind of things. It's easy to get way out ahead of that. It's easy to be way late to that. And one of the things we've seen consistently from our friends at Activate is that they tend to hit those marks, right? And I think that, again, comes along with a bit of experience to know sort of which of these cycles are blips and which of these cycles are, truly the next wave coming.
Thanks, Rob. I think I'll tell you where we've gone, which is really interesting because I think it's happening across the industry. In Fund 2, which was 2021 to 2024, we were 3 buckets of investment. It was climate finance. How do we get these technologies into the market much more quickly? So, I was on board of Solar City, took the company public. They did that for residential solar. We did a similar company called NPAL in Germany, really big business, not just doing solar, but electric heat pumps, EV chargers, storage. And we think that's an important thing, like unlocking the capital versus operating costs of these technologies. So we did about a third climate finance. We did about a third software. And we did a third technology-enabled services using software internally to do something that was interesting. So give you an example, we're investors in a company called Voltus. They're a flexibility layer for the wholesale energy markets. And so instead of needing to generate more electrons, they just decrease load in the grid by tying into tens of thousands of points of load. So it could be smart thermostats, it could be buildings, it could be Bitcoin miners, you name it. And so really smart software to be able to do that in real time. Amazing business. Fast forward to Fund 3, the world's fundamentally changed. And so it's changed because we have moved to a whole new set of technologies that require much more power. We make 6 investments in Fund 3. They're all hardware related, which is amazing because we started making a pivot into data centers back in 2023. We knew it was going to be important. We wanted to be the picks and shovels in data centers. So we invested in Crusoe Energy and more recently a company called Xenergy, XNRGY. Crusoe is a developer bringing renewables to big AI data centers. So they take a lot of curtailed wind and solar in Texas along with natural gas. They build really effectively for the big hyperscalers. So Xenergy is providing a liquid cooling solution that uses way less water and is 35% more energy efficient. And so they're getting a ton of traction in these big deployments because energy and water availability are critical for data centers. So it's a picks and shovels approach, but it's a physical thing, right? That's not what we... a lot of people didn't think a lot of us were doing, so it was all more software. Fast forward to where we are in our economy, all these systems of infrastructure require maintenance, require people. And so historically, it's been done by people enrolling trucks, but labor availability, we realized for skilled labor in the United States was going down. We don't have as much immigration as we used to. In fact, the opposite. And so it's hard to get people who want to do these jobs. So we invested in a robotics company out of Riga, Latvia, called Aerons has built robots for crawling inside and outside of wind blades. Wind blades have problems. They need to be inspected for cracks. They need to be repaired because the leading edge breaks down. And it used to be people. And it's really hard to find people who want to go up 500 feet on belay on a wind blade. It's dangerous. A lot of the wind is West Texas, which is the middle of nowhere. And so trying to find labor availability in these places where a lot of our infrastructure is hard. And so they've gotten huge traction in Texas, even though they're European. It's over 70% of the revenue here is in the United States. And it's safer, it's quicker, less downtime for your turbines. So we did something very similar. We invested in a robotics and drones company doing transmission line stringing called Infravision. Rob, you were going to talk about it. I'm going to talk about it anyway because I think it's a great company. The CEO and founder was was in the Australian military. And he was in the helicopter crews and just saw how dangerous it was. And the way they string transmission lines in the developed world, it was helicopters. You have a helicopter with a little platform with 2 people sitting on it. And that's just dangerous. And you need to be sighted because you're going over where places live. Helicopters crash a lot. So there's a safety concern there. And then in the developing world, it's people. It's just like 100 people pulling lines. And so he realized there was an opportunity to improve the safety, increase the ability to deploy transmission, which is a critical component of not just having more electrons, but also bringing decarbonized electrons onto the grid, because a lot of the places where wind and solar are not where people are. Either there's not a lot of land availability, or you need to build really, really big things, or the wind's not blowing. And so they've gotten a huge traction in India. This was really interesting about India. India doesn't have a lot of oil. And what we're hearing right now from the administration in the fight with Modi and Trump is that, hey, you're importing Russian oil. It's true because they don't have any, very little. They have some pretty bad coal. They have a coal resource, but their best resource is solar and wind. And solar is the fastest source of generation in India, but solar is not where the people are. And so transmission is super important. It's incredibly important for our decarbonization goals, and for India's energy security goals are not dissimilar to Europe. They don't have a lot of energy, and so this company's focused 100% on increasing reliability. They've run thousands of lines on their drone plus robotic system that pulls the line. So that's sort of an advanced technology that finally have come down the cost curve where it can be applied to our industries that we care about, right? Before, robotics were mostly inside automation of factories, big factories like ABB, and a lot of big companies have a lot of really good robots, and it's moved into Amazon warehouses. And now the technologies has miniaturized and scaled, the software and hardware reliability have come to a place where there's lots of applications. And that's theme number 2. The last areas, the last 2 ones we did, the electrification deal is a company called Jetson, which is doing electric heat pumps in the U.S. market. Europe has taken off in terms of heat pumps. So you go to Scandinavia, 85% of heating is through heat pumps. U.S. is much lower. It's like 5%. And so, that's because people don't know them. Either you have oil in the Northeast, which people still use, my home did when I grew up, or you use natural gas. If there's infrastructure, or use electric. But electric heat pumps provide both air conditioning and heating. They're amazing. They've come down the cost curve. It's just a direct-to-consumer play, very similar to SolarCity. So love that. And the last one's a company called Nuance Space, which is a low Earth orbit satellite business, right? It's hardware, it's software, it's mission control. It's really complex stuff to launch low Earth orbit satellites, or LEOs, mostly for Earth observation. Think about it as methane sensing, fire sensing, launch your first fire sat with Google and the Moore Foundation. It's for weather, humidity, and temperature. So, there's lots of applications because all these technologies have come down the cost curve, which opened up the availability of new applications. 6 hardware companies.
What's been occurring to me as we talk here is a couple of things which I wanted to kind of tie together and then get your thoughts on, Raj. So one is, when we were talking at the beginning, we were talking about sort of 2 different visions of the missing middle. But in my mind, they all have one consistent theme, right? Which is that there are a lot of investors who are investing early stage into this set of sectors. And then there are billions upon billions of dollars that are just waiting for good, established, growing companies to be there, that are basically just wind the crank, ready to go, just own them and watch them run. But there is this middle for you guys. It's, growth equity. For us, it's early deployments of project. But, there's really this gap in the middle. And you're exactly right that when you look at the numbers, there is a paucity of growth of dollars that, if you look at what would be implied by that sort of straight line that I was just, verbally painting, there's a dip right there in growth. To what do you attribute that?
Well, look, our industry has fundamentally changed. Like when I joined venture, I graduated from Stanford Business School in 1997. A big venture fund was $400 million. Like most of them were sort of 250, and even DFJ and the funds before me went from 50 to 100 to 200, quickly scaled. But there weren't these mega funds. And so, the amount of capital that's going into any of the private asset classes, whether it's private infrastructure, private equity, growth or venture, or even private credit now, which is, a big sector, the scale of it is off the charts. And so that has meant that a lot of folks that used to be sort of traditional growth investors, not in our space, but traditional growth investors like TCV, IBP, a handful of others, are much bigger firms. And there are a lot more firms that have come in at much bigger scale. And so that gap, and it doesn't make sense for them to invest small amounts of capital. It's overhead relative to the amount of people and the amount of capital they want to deploy to be able to cycle into new funds. And so that's left a gap. The early stage funds are always going to be there. They play such an important role. They're at the front end of innovation. And so whether here or Europe, there's a lot more seed funds, there's a lot more early stage funds. In our sector, it's over 100 that are really good at what they do. But it's their ability to tap in and access larger pools of capital. Those larger pools of capital have moved up for the most part. And that's true on the infrastructure side. So Rob and I are in the same boat. Like there's a missing middle for him because of both first of time folk or first of time facility, but it's also because capital, right? People want to deploy massive amounts of capital. And so there is that bridge where folks like Springlane or Activate, we're trying to play that role. And it's hard. It is just hard. Like it's heavy lifting. It's a lot of ups and downs sometimes for companies, even they're mostly moving up. There's always bumps in the road until people get modus operandi down or get the playbook down. And so we like it because that's what we do. I think Rob feels the same way. It's so fulfilling for us as a set of partners and investors to be just hands-on with other companies and helping them bridge that gap and get them to the next level. But the part of it's structural. Back to the question, Jason, it's part of it's just structural, which is way more capital and way bigger funds and way bigger platforms. A lot of the big, what used to be public platforms, even the big sovereigns have all come into privates over the last decade. They used to come into funds. And so whether it's Canadians, Australians, the European funds, a lot of them are going direct, or in the state, a lot of the state plans are also investing in the big platforms, right? Because they need to deploy a lot of capital. And so it's interesting because, the private equity business was always big, started the LBO business right in the 80s, and then, it got much bigger. But even the technology side, which used to be the side of innovation, these funds are now really big. You look at Thoma Bravo as an example, or Vista as an example. And so it's just a maturation of the sector, particularly for those guys in software. Software as an industry has matured, right? So now you're seeing a lot of that capital moving to AI, and that's fueling a lot of innovation and growth. And so it makes sense. And for us, we're in a maturing sector in that wind and solar have matured. That's not what Rob's investing in, right? He's investing in next generation technologies that were where wind and solar were back in 2008, 2010, 2012, when you can get returns of mid-teens or high teens on those technologies. Or storage. Even through 2019, people were not investing in storage. Even though lithium-ion batteries have been around a long time, they were coming down the cost curve. Now storage obviously is really big and lots of big capital. So our goal, whether it's you're doing infrastructure, you're doing companies, is to bridge that gap.
Yeah, and I think as well, on top of that, I think there's this misperception that all the hard work is at the early stage, because it is a formation stage, right? You are figuring things out. And I'm not saying it's easy, but that's not where all the hard work is. Right. I think one of the things that we find, whether it's, about the deployment of assets or whether it's just simply the growth stage of a company, they're having to make some major changes internally. Right. They're having to professionalize. They're having to figure out how to scale. That's its own special set of disciplines and skill sets. They're having to start to act like a big company before they are a big company and have big company resources. And so that's where not having access to, the necessary amount of growth capital, I think, has really held back a lot of the companies. That and the fact that, as Raj has alluded to a couple of times, but I'll just sort of draw out, there's a need for growth capital. And then there is also a need for steel in the ground, steel on wheels, whatever the case may be. Not for every company. Some companies are pure software and like, but where there is that need, it's a mismatch. Raj just alluded to some of these technologies can yield, he described it as high teens. I would say even in many cases, it's even higher, but even 25% returns on these assets is lower than the expected rate of return on the corporate dollars that people put in. So if you're taking corporate balance sheet capital that you raised through growth equity and you're funding steel in the ground with that, you're basically subsidizing the steel in the ground with more expensive capital. And figuring out how to build that much more robust and diverse capital stack where the right capital is for the right purposes, and talking to a whole panoply of, now much more sophisticated and corporate customers, because you're in a growth mode and you need to go to where the big customers are. That's really challenging. I'll give you a concrete example. We have a company also in the data center space, probably a recurring theme in a lot of podcasts right now. But this company is called Soluna. They also do, green data centers where they're leveraging curtailed power. And we've backed them now across 3 different projects. And the noticeable difference of their own internal maturation over the course of constructing that first project to now the third one. The first one almost felt like a labor of love. Like, how are we going to build this? Even like, what's the right way to do the concrete pads for these buildings and things like that. Now with the third one, they put shovel in the ground at the end of the summer, and it's basically already at mechanical completion. Right. So there's just a learning curve that all of these companies have to go to. That's a construction example, but I know the same thing happens if you're talking about, like infravision and, what's the right way to deploy these drones so that they can lift heavy objects.
Yeah. Hey, Rob, you're right on. Like the learning curve on, whether it's projects or case hardware as a service in the case of infravision or air-rounds, it's all about getting the cost to serve down. You get a lot of learnings. Like that's even traditional manufacturing for big companies that do it and do it often. Learning curve, even on a per plant basis, is unique. And so, as I think about what we do, like there's the early stage of the business where it's founder led, and it's up to the founder to make the sale. Right, it tends to be evangelical sale in a lot of ways. Right, doing something new to replace something that may already be working okay. Right, so as an example, or something that people don't know they need, right? That takes someone that's a founder. And so as you move to scale these businesses, like from the time where these companies are, where either Rob enters or we enter, there's still a lot of building. There's like, okay, now we need to train a sales force to be able to sell the same thing that the founder could sell, but not everyone else can sell. And so that's, have you found the right product market fit? Do you have the right messaging in the right market? Then it's decreasing the cost to serve. One, improving the serviceability, improving the reliability, like as Rob was talking about, decreasing the cost to whatever you're doing. And then to scale, it's, the cost to serve doesn't have to be always direct. So trying to build channel partners. Who are the networks and relationships you have that will decrease your cost to access the market? How will you expand your TAM? By going into different geographies or thinking about other companies or technologies to acquire and build. And so there's just a lot of heavy lifting in the stages of companies where we both play, right?
Yeah, that's right. I mean,
not for you must be like, first of all, you're finding a EPC to build something where you probably have a lot of custom engineering. And right. As you think about scaling that, like moving up to maybe more mature EPCs that can actually wrap a contract, right? Provide risk assurance for off-takers who are doing the PPAs. That just, And people need to see those projects. They need to see the economics, right? Like,
That's right. The folks at the other end of the valley of death of the missing middle, they expect all that to be solved by the time the company shows up at their doorstep looking for financing or to be acquired, right? I mean, you anticipated a lot of my questions that I was going to ask you here. So with your permission, I'll actually throw you a couple of curveballs in the interest of like a little masterclass here, get inside the head of an experienced investor at the growth stage. I was once invested into a SaaS company, software as a service company, and I was co-invested with a very experienced SaaS investor. And this was a revenue stage company. And I learned a lot from him about what specific metrics he was looking for, right? And the intention was, how do we take a sales process and a deployment, basically an onboarding in that context process, how do we make it as very predictable as possible, not just from a timing and what do we do, do this perspective, but also in terms of, okay, well, my ideal is if I put $1 into marketing, then that will result in this pipeline, that will result in this conversion of the pipeline, that will result in this amount of dollars that comes out the back end. What key metrics do you tend, in the boardroom to hammer home with your CEOs that you partner with, right? Are there any key ones that you have as touchstones that you always bring out?
So look, if you're doing a SaaS business, the SaaS metrics are pretty well understood. That's why a lot of people do SaaS, because they can just metricize the business and figure out if their LTV to CAC makes sense, like all the things you think about. And you can run the lines to get to cash flow break even based on growth rates. And you can say either I'm targeting 200 million or 100 million to get the cash flow break even. For our business, particularly when there's a service component to it, it's just very different. And so we always make sure to look truly at the cost to service. So, you've got R&D that is, unique. So you promise customers features or functions. You've got the underlying cost of labor that would be contribution line, not gross margin, contribution margins. We always look at contribution margin. Are we actually making money? Because if we're not, we got to figure out a way to make money. That means we have to decrease the cost to serve. So it's not just, and so contribution margin to us is critical. And we always spend a lot more time on contribution margin. Just gross margin hides a lot of stuff. A lot of the service component behind it, and a lot of the stuff behind it. And so that's number one. We always look at sales efficiency, and try to make that better and better. And then you're not going to have great sales efficiency early on in a young company because you haven't figured out the message effectively. You haven't figured out the core market. And it's funny, when I look at our young software companies, I've done a lot of software, did a lot of SaaS early on in my life. And it's when I see companies that have disparate customer bases, it always that they just haven't figured out that they're selling. They're just selling. You see churn in that early customer base because they're selling to customers that actually don't really need what they're delivering, or their product doesn't deliver what they thought they could deliver just to make the savings they want or efficiencies they want. When you see a really good company where they've nailed down, hey, I'm going to go after, here's a pain point in one sector, and they've nailed it, and they got multiple customers in that sector, then they found a really good.
Yeah, I'm actually acting as CEO of one of our portfolio companies right now. And one of the things which I've learned is how much of a misperception there is around product market fit. You get the sales team, they come back, they say, we sold this. That means people want it. That means we have product market fit. And what you're describing is much more of a replicable, very targeted, very predictable, this is exactly the kind of customer, this is exactly the kind of cost to service that is required to give them a particular service that we know will scale. And I think that's one of the misperceptions. And it goes to what we were talking about earlier about how there truly is a lot of hard work at this stage. And it's just not, oh, great, somebody got it through to being a growing company. Now, just bring in growth capital and we're good, right?
In our sector, Rob, seriously, we don't have a lot of companies that could be like a snowflake that can really scale that quickly. So we're selling to energy and the industrial sector, a lot of things where physical infrastructure is part of the equation, where you're running a plant or you've got physical assets, and to change the way people operate those assets, either operations and maintenance, could be lots of things around cybersecurity, which is important in these locations. It's just slower than it is for other industries. Adoption into those physical systems tends to be harder. There is a plant manager who actually has to, and you may sign a contract from a chief security officer for 200 plants or 50 plants, but the plant manager has got to shut down and deploy it, and just takes a little longer. It's funny, when I looked at a bunch of the early AI companies back in 2018, 19, I remember one. I think they had a cement facility in Mexico. They had a ship coming out of Dubai. They had like 7 customers. They're all so different. I was like, that's a company that just had not really found its niche yet.
Yeah, still discovering the market, right? Yeah. So,
as you know, the sales guys get paid for this stuff. Like they're trying to sell whatever they can sell, right? So you'll see like $50,000 ARR contracts or $25,000 ARR contract. You can't make money on direct sale, if you're doing direct sales on that kind of ARR. And so you got to start. But like our job as investors is to really try to figure out where they are. And so sales efficiency for us is important.
One of the things that we're invested into, for instance, in a couple of our portfolio companies is the electric vehicle space. Over the course of 2025, the headline environment around electric vehicles has been absolutely dreadful. I think we can all acknowledge that. In your eyes, how important is it to be a contrarian investor, right? We spent a lot of time talking about data centers and data center related things and electrification because, I guess, what was the bank robber's name? Willie Sutton. That's where the money is. But how important is it to get out ahead of, if you're a Gartner hype cycle fan, drop of disillusionment, or is that a bad idea?
It's a really good question. I think the job that, so I've been through multiple big peak cycles. I remember .com very, very well. Going to 2008 was GFC. Clean Deck was 2007, 6, 7, 5, 6, 7. Your job is to figure out where the puck's going. Using a great Wayne Gretzky quote, right? Everyone knows it, so I'll use it. But you got to skate to where the puck's going. And I think there's no reason to be contrarian just for contrarian. Like you got to figure out the fundamentals. Like that's what we always say. Why now? We want to know. Like we want to have a fundamental belief of what's happening. So look, just take AI data centers. AI is going to be super important in the world economy. It's the fastest growing sector in the world, which means a lot of capital is going after it. So you got to figure out, are you at a local optimum? Because if you think about the R sector or even the .com. So peak was 2000, March 2000. I joined DFJ in January 2000, just in time. We'll crash. And the Wall Street Journal published something, $100 billion of venture capital was wasted, blah, blah, blah. But fast forward 25 years, the internet's fundamentally changed the way everything was done, right, in the world. And so it's incredible. So the local optimum peak never really catches up to the eventual success of these sectors. But you've got to know where you are because you can lose a lot of money. And so you want to be on the macro trend lines, both in terms of technologies. You got to get that right because then you can get that right. If you're smart, you can get that right. If you just pay attention and make the calls, figure out, the technology platforms. You may make a mistake on which technology platforms win or lose, but the macro has got to be there behind it. And then you got to figure out where you are in the cycle. And you should not run away from companies that are on the peak. Like, we're deep in data centers right now because it's fundamentally, it's a moment in time where a lot of data centers are being built. They need picks and shovels. They need next generation cooling solutions. They need more power and availability. They need more flexibility. It's a big theme. And then the contrarian bet is, going back to EVs, look, there's no doubt we're going to electrify our vehicle fleet. Like China's already doing it. They're making great cars. They're better than Tesla in a lot of ways. And there's more. In Europe, same thing. And so the U.S. has got to figure it out. Now we've got infrastructure issues. We drive further, but I'll tell you, the amount of, we've got a house up in Sonoma, and our gardener was awesome as a crew. And he's, he came up and he pulled up in a brand new Cadillac EV. I said, how old is he? He says, 2 weeks old. And it's a big one, 600-mile range. I was like, do you like it? I love it so far, but I haven't really tried. And it was just cool to see because once, people see the value, you don't have to go to get an oil change. You don't have to go get your 3,000-mile tune-up. And it's really easy. I've owned a Tesla Model S since 2012. It's 13 years old. I don't really need new cars. So it's just, I love it. My kids make fun of me because it's super old, but I'm like, why do I need it? It's great. It works incredibly well. And so I think we'll see that. I think we need to see more infrastructure. The first generation infrastructure is broken, right? Horrible experience unless you're on Tesla, so we need better infrastructure for the consumer to have a good experience.
But to your point about the fundamentals, we're used to vehicles that crap out at 70,000, 100,000 miles. We celebrate a traditional internal combustion vehicle that lasts over 100,000 miles, right? People film it turning over and then put it on TikTok. And, these things just inherently last 2 or even 3 times as long. So what does that do to the financing market for these electric vehicles? What does that do to the commercial fleet service market, right? All of the fleet managers that are out there serving commercial fleets, how do they have to think about this differently? And so, right, that's a great example. Last question here. A couple of times we've talked about this. Electric vehicles are a good example. Solar, a good example, where you have increasingly a total cost of ownership that's on par or even better than the incumbent traditional solution. But it comes with an upfront capital cost. A lot of that total cost of ownership advantage for EVs, for instance, is not only the lower fuel cost, that's obvious, but also the lower maintenance and also the fact that it lasts longer. In many cases, not always these days actually, but in many cases, electric vehicles cost more, certainly solar. Long-winded preamble to ask, what's more important, do you think, for the success of our sector and therefore for us as investors? Is it supportive policy environment or is it low interest rate environment?
Such a good question. It's a really good question because low interest rates enable you to take that CapEx, incrementally more expensive CapEx decision and make it an OpEx decision for a consumer, for an enterprise. With higher rates, it makes it harder. So it slows down deployment. And luckily, solar and wind and storage still work with the increased environment. We've been in a zero interest rate environment for a decade, and that's created a lot of great stuff in our industry because it enabled the scale down, the cost down of all these technologies. Interest rates are great. Policy is really important for sectors that are still emerging. Like nuclear is a good one. We're trying to rebuild our nuclear fleet, whether it's on traditional Westinghouse technologies and trying to scale that at large scale, or whether it's the SMRs. It's really critical. So we've lost a lot of that capacity. It's, Europe still has it, China definitely has it. And so I think the administration has done a very good job focusing on those sectors. So whether it's policy or direct government intervention or loan guarantees, like Tesla Tesla's not alive today. We don't have an electric vehicle industry in the United States if it wasn't for a big DOE loan guarantee, $450 million. There's timing because they were stepping into the NUMMI facility, which was going bankrupt, the GE and Toyota joint venture. And so a lot of things had to come right, but certainly government policy was super helpful in the nascent stages. I think there's something that is right about there's only so long that policy framework should be in place because I think companies will innovate. Like solar is a good example. Like rooftop solar in Germany, in Australia and Germany, you put rooftop solar on super cheap, right? 25% of Australian homes have solar. Like we're not even scratching that surface yet in the United States because it's super easy, super cheap. Germany saying that you can get a loan and get permitting done in 7 days. Solar is easy. Try getting permitting here in the United States for a home, which is harder. And so we've got to solve a lot of those things, which is a big chunk. And then there's, then for like residential solar is $2,000 or $3,000 customer acquisition cost. Got to decrease that, right? Like there's big chunks of ways to decrease the cost of solar in the United States that doesn't require subsidies or the ITC. And the industry is going to innovate. They always do, right? That's just, you got an entrepreneur, you get a company, if there's a way to make money, maybe decrease the playing field, you open up innovation. Like we're still big believers in all these technologies for sure. We're investors coming to Lunar Energy. Lunar does a home electrification. They do solar plus an integrated DC storage system. We're going to electrify the home for not just resiliency, not just lower electricity prices, but it's going to happen because it makes sense. Like it just makes sense. And so that is a big area of innovation that's happening. And I think that the home electrification is a big theme for us. And we think it's important.
Guys, amazing conversation. Love the nuanced back and forth. I want to wrap up with a prediction from each of you. Speed round, start of 2026. What's going to happen this year?
It's going to be an amazing year. Like it's going to be a year where the big, large tech companies will continue to generate 13 to 15% earnings growth. So the S&P 500, unless there's an outside shock, the S&P 500 is going to get more diluted down because right now most of the growth is the top 7 companies. But you're going to see, and all the other ones are forgotten about, even though they're doing really well. And so it's a little bit of an economy of have and have-nots. And so right now the market's on fire because these 7 companies have grown really quickly, but it's all the underlying infrastructure. Like GE Vernova has been an amazing stock, right? Because you need gas turbines, right? And so if you look at it, it's been a 4 or 5x, I think. And so I think all that's going to bleed down, and there is a lot of debt from the U.S. economy. And so that's number one. I think earnings growth is going to be broader. It's going to be bigger. People are going to deploy stuff. The public market confidence is going to increase. So IPOs are going to happen. And so it always happens. There's always been, the IPO market's already open. And there's some big companies that are going to go public. But there are definitely some really, really stalwart ones that will go that will sort of change the frame of reference. And the IPO market always goes up and down. So I think we're going to see a lot of IPOs. We're going to see a lot more M&A. You're already seeing it. And so I think my view is 2026 is going to be a great year. In our sector, there are definitely companies that will, either in 2026 or 2027 will tap into the public markets. Rob?
Yeah, I'll actually start by answering a question I asked you earlier and point to the importance of interest rates. And we're recording this on a day when the Fed just dropped the rate another 25 bips and signaled that there's going to be another one. And You match that against all the dry powder that is out there in the private equity and the infrastructure world, which infrastructure dry powder dropped a little bit in the last year, but now it's on the uptick again. And private equity, infamously high amounts of dry powder at the moment. And that's all exit fuel. That is all exit fuel. You know, you're going to see a lot of companies IPO, like you're saying, Raj, but also a lot of companies talking about IPOing, because then that prompts the M&A conversations. And when that gets prompted, then you're going to see a lot of these firms that are sitting around on all that dry powder. And now that the interest rates are dropping, then it makes it cheaper for them to do the acquisition. And that's true whether they're acquiring it to put assets out there. You know, we've seen our firm, at least, where we've seen exits out of our portfolio, you know, a couple of them have been from larger infrastructure firms coming in and saying, not only do we like those projects, and not only do we want to fund putting those projects to work, but we want to own the whole platform because they have a good pipeline of these projects. And so if they see it being more attractive because of low interest rates to deploy the assets, to deploy the projects, then that's going to make them more interested. And then also, like I was just saying, in the private equity world, same kind of dynamic. If they can get cheaper leverage because of lower interest rates, then that allows them to pay up and get more comfortable purchasing companies at whatever stage the company is at. I agree. I think 2026 is going to be a really big year, not just for our sector, but overall. But specifically in our sector, I think, you know, and we didn't really touch on it, but I kind of feel like, and this, Raj, you've been around long enough to know this is actually a bold prediction, but I kind of feel like we might be finally at the cusp of that mythical, it's no longer its own sector. It's no longer clean tech, climate tech, sustainability, whatever we want to call it. It's actually just part of the landscape of all of these other traditional sectors. And, you know, it just sort of feels like
I think that's super smart.
Climate tech. Yeah, they're not going to call it climate tech. They're going to call it, you know, like energy and advanced manufacturing or what have you. But people are going to be buying back into it because, like you said, these things just make sense now. You know, stop talking about it as green. Just start talking about it as the stuff that makes more sense right now.
I think you hit the nail on the head. I think there's a convergence. I think you're right. We don't really even term it climate, right? We're doing a lot of stuff in energy and infrastructure, and that infrastructure is broad. It could be logistics, supply chain, space, you name it. Yeah, and obviously data centers and the like. So I think that's right. And part of that's because we're in an economy that used to be the energy sector was really separate, right? Oil and gas were for transportation and for, you know, the and for the chemical industry and for the plastics industry and for, you know, electricity and power. It didn't really intersect. There was no like pain point in compute for power, right? Until now. And so that's why you're seeing a convergence of a lot of stuff. Then you're also seeing 25 years or even more of real technology acceleration and cost down across all these technologies that were hard. Like AI, you forget AI has been around forever. You know, like I've been looking at, you know, AI companies, machine learning companies for a long time, but, you know, it took a lot of things to come together for it to really, you know, really get to the point where it can accelerate. It's sort of like the activation energy.
Yeah. And I also think this is going to be the year where people figure out that this is kind of a big thing to put at the very end of a podcast, but data is a lot more geographically fungible than electricity and power. And what does that mean? It's a lot bigger than just where do you site a data center.
Ending on a cliffhanger. I love it. Rob, Raj, amazing conversation. Good to the last minute. Thank you for being here. I learned a lot. Really enjoyed.
Hey, Jason, thank you for the time today. Really appreciate it. Rob as well. Thank you for having me on.
Thanks for joining us for this episode of Invested in Climate. Please remember to rate us on Apple, Spotify, or Google. Find show notes, sign up for updates, get in touch, and visualize your climate action at investedinclimate.com. This podcast is for informational and entertainment purposes only and does not constitute financial, accounting, or legal advice. Thanks again.